This is part 2 of a 2-part video series on how to pay less taxes. Let's continue with number 5, tax-efficient investments. Want to explore some ways to save tax while potentially growing your money? You might want to look into VCTs, venture capital trusts, EIS, enterprise investment schemes, or SEIS, seed enterprise investment schemes. These are government-backed schemes designed to encourage investment in smaller, higher-risk companies, and they come with some pretty attractive tax breaks. Here's the basic idea. When you invest in these schemes, you can get between 30% and 50% income tax relief. So, for example, if you put £10,000 into an SEIS qualifying company, you could get up to £5,000 back in tax relief. That's like the government giving you a discount on your investment. And there are more benefits. If your investment does well and you sell your shares for a profit, you won't pay any capital gains tax, CGT. Plus, after you've held the shares for a couple of years, they're usually exempt from inheritance tax, IHT. Now, it's really important to understand that these investments are higher risk. You're investing in startups, and there's a real chance they might not succeed. This is why the tax breaks are so generous. They're there to compensate for that risk. Let's look at a few simple scenarios with SEIS, where you get 50% income tax relief. Worst case scenario, the company fails. You invest £10,000 and get £5,000 back in tax relief. So, your actual investment is effectively £5,000. If the company goes bust, you can also claim something called loss relief, which can reduce your tax bill further. This means your maximum loss is significantly reduced. Break-even scenario, you sell for the same amount you invested. You invest £10,000, get £5,000 back in tax relief, and then sell your shares for £10,000. You've effectively made £5,000 due to the initial tax relief. Best case scenario, the company does really well. You invest £10,000, get £5,000 back in tax relief, and then sell your shares for £20,000. You keep the entire £10,000 profit tax-free, plus the initial £5,000 tax relief, giving you a total return of £15,000. It's crucial to remember that these are just simplified examples. The actual outcome of any investment is uncertain. These investments are high risk, and you could lose some or all of your money. As always, it's essential to speak to a qualified financial advisor before making any investment decisions, especially with higher risk ventures like these. Number 6, spouse or partner. Income splitting. This is a strategy that can work if you and your spouse or partner earn very different amounts. The basic idea is to shift some income from the higher earner to the lower earner. Here's how it works. If one of you owns assets that generate income, like a rental property or investments, you could consider transferring ownership of some or all of those assets to the lower earning partner. Because the lower earner is in a lower tax bracket, the income from those assets will be taxed at a lower rate, meaning you pay less tax overall as a couple. For example, let's say one partner earns £80,000 a year and the other earns £20,000. If the higher earner owns a rental property that brings in £10,000 a year, they would pay a higher rate of tax on that rental income. But if they transferred ownership of the property to the lower earning partner, that £10,000 would be taxed at a lower rate, potentially saving you a significant amount. However, it's important to be aware of the rules around this. It's not simply a case of temporarily shifting income to avoid tax. The transfer of assets needs to be a genuine transfer of ownership. Also, there are specific rules around how this works. So it's essential to get professional advice from a financial advisor or tax specialist to make sure you're doing things correctly and that it's the right strategy for your specific situation. Moving on to a more complex area, using trusts. If you're thinking about how to pass on your wealth to your loved ones, there are ways to potentially reduce the amount of tax they might have to pay later. One option to consider is using a trust. A trust is like a legal container that holds assets, things like money, property, or investments, for someone else. There are people called trustees who manage those assets for the benefit of others, who are called beneficiaries. There are different types of trusts, and each has its own set of rules, including specific tax rules. Trusts can be helpful for reducing inheritance tax, IHT. IHT is a tax on your estate. That's everything you own when you die. It usually applies if your estate is worth more than £325,000. Anything above that threshold could be taxed at 40%. Putting assets into a trust can sometimes take them out of your estate for IHT purposes. Trusts can also have implications for capital gains tax, CGT. CGT is a tax on the profit you make when you sell certain assets. How trusts interact with CGT can be quite complex, and it really depends on the specific type of trust. Another way to potentially reduce IHT is by giving away assets during your lifetime. If you give something away and live for at least 7 years afterwards, it generally won't be counted as part of your estate for IHT purposes. However, there are some exceptions to this rule, so it's not always straightforward. The key takeaway here is that planning ahead is really important. The earlier you start thinking about these things, the more options you'll generally have, and getting professional advice is absolutely crucial. Tax laws, especially around trusts and inheritance, are very complex, and what works for one person might not work for another. A qualified advisor can help you understand all your options, explain the different types of trusts and how they work with both IHT and CGT, and clarify the rules around gifting. This is not something to attempt without professional guidance. Finally, this is probably the most important point of all. It's crucial to remember that everyone's situation is different, and what works for one person or business might not work for another. So, getting tailored advice from a qualified professional is essential. Think about it this way. One thing that often sets wealthier people apart is that they understand the value of expert advice. They leverage the expertise of others to protect and grow their wealth. When it comes to something as complex as tax, it really pays to get professional guidance. A qualified accountant or financial advisor can help you understand your specific tax situation, identify the most effective tax-saving strategies for you, ensure you're complying with all the relevant tax laws, create a long-term financial plan that takes your tax situation into account. So, don't try to navigate the complexities of tax on your own. Investing in professional advice can often save you much more money in the long run. If you've successfully used any of the methods we've talked about, or if you have other tax-saving tips to share, please let us know in the comments below. We'd love to hear from you. Thanks for watching, and we'll see you in the next video.